also for the invitation. It's a pleasure for me to be with you today here. This particular slot is intended to be a little different from the rest. It's certainly going to be less academic, or almost no academic at all, and it's intended to be more practical. You know, this is about quantitative techniques, quantitative finance. So we thought it would be interesting for everyone to have a feel of how this works in the real world, in real banks or real life insurance companies, the ones that you might have in the office next to yours, or selling products in the bank branch outside your house. So basically, I've got a few slides. Can you see a sort of big blue title slide, which is called Quantitative Finance in Life Insurance Practical Example?
Perfect.
You can see that, can't you? And now if I change, you can see the second one.
Perfect.
Right. Okay. So this is working. So basically, well, you know, VidaCaixa is the largest life insurer in Spain. We sell our products via the CaixaBank network, which is also the largest bank in Spain. And things have changed a lot in life insurance over the last few years. In the old days, we had probably one single product, which is a protection product, of which you can see an example in this advertisement. It's a pure protection product that would cost you $15 per month. So in case you die, your family would receive $250,000 as a sum assured in case of death. This is still working, and this is working very well. We continue to sell these products, sometimes associated to a loan or a mortgage, but basically the same product. And the quantitative finance, if you could call it quantitative finance behind this product, is quite simple. I would take the 250,000, multiply it times the probability of death. That probability of death could be associated to probably the age of the person who wants to undertake the insurance, and that would be the basic premium, on top of which I would apply my surcharges, etc. Very simple. But compare this to the types of things that we are selling today. This is a real advertisement for a life insurance product, which is different from the one that we saw before. This one begins with the person, the insured, investing in $100,000 into an investment fund, and see how this works. First of all, automatically, the fund is credited with a 4% annual rate every year as a minimum. Now, if the stock market goes higher, as you can see in the sort of gray area there, then it is consolidated. So I would reset that sort of minimum guaranteed rate to the highest of the fund value or the guarantee level every year, and then entering into a second phase. If the stock market goes down and declines, then your value is fully protected. So you benefit from the upside, you have no downside. This is fantastic for saving for your retirement, because you can plan for your retirement knowing in advance the amount that at a minimum you will have in order to buy yourself an annuity or do whatever you want. This is the types of things that we are selling now. Much more financial in nature, much more complicated, and usually with the distinguishing feature of having embedded options. We put options everywhere these days. We sell package products with investment funds and options, lots of options, normally put options, which are given or sold, more appropriately, to the client. So things have changed a lot for our business. We are beginning to change ourselves in terms of our own organizations and how they are made up of people. Our profiles are very different to 15 or 20 years ago. We have mathematicians, we have PhDs in physics with quantitative finance doctorate or whatever. So we have changed a lot ourselves in the way we do business, and this change has been quite dramatic. So let's get back to understanding the sort of basics of this business and this type of products and how it works. Imagine that you are 61 and that you are planning for your retirement at 67. Your probably safest possibility is to invest in a 6-year government bond, and then if you eventually retire at the age that you want to retire at 67, then you would sort of receive back the principal of your bond, and you would have earned a minimum interest, probably even negative these days, because the 6-year government bond rate in Spain is either negative or almost negative at this point in time. And with the further added market risk that if in the meantime you undergo, for instance, a medical emergency and you need the money back, then you are exposed to market risk because bond prices fluctuate with interest rates, and then you might need to sell, and if you need to sell, then the market might have gone up or gone down. So there is a market risk involved. You could die as well in the meantime, and then your beneficiaries would need to also sell that bond, incurring in market risk. Now, imagine that instead of a government bond, you invest in the stock market. The stock market is much more volatile than a government bond. So you would have a lot of other uncertainties. If the market goes up, then that's perfect because you will have more money to retire. But you need this in the end. In the meantime, there's a lot of intermediate volatility. If you undergo, as we said before, another medical emergency and you need to cash in your money, then you might find yourself in a position in which the value of the fund is much, much lower. And if you happen to die, then the inheritance of your beneficiaries, your siblings, would be or could be severely affected. So it's good to have the upside. We all want to sort of grow our wealth up to retirement and after retirement as well. But the downside is very limiting, particularly considering that these are normally the savings of your lifetime. So you're normally risk averse to it. So what are variable annuities? It's a type of product where the policyholder, the insured, invests in a mutual fund, in an investment fund, which is normally called a unit-linked account for technical reasons. It's a bit of a strange name, that unit-linked thing, but that's the way it's actually called technically. They are normally funds with a lot of equity, with a lot of exposure to the stock market, more than government bonds. And then the insurance company goes in there and says, okay, you have this fund, you have bought this fund. It works as an investment fund, so it can go up and down, and you can have it for as much time as you want. But you can guarantee many things, as many as the policyholder wants to pay. You can, for instance, guarantee that a minimum account value will be passed on to the beneficiaries in case of death. This is called a death benefit. Or you can also guarantee that, for instance, at retirement, you would have as a minimum a certain amount of money, or that you will be able to invest in an annuity, a series of payments, a pension, yielding you, I don't know, for instance, 600 euros every month. You can see it as a sort of one-off payment, a minimum one-off payment, or as the pension that I want to buy upon retirement. That is guaranteed. And on top of that, the value that you can have from there in terms of the possibility of the stock market going up and earning that upside is unlimited virtually. So these are very, very popular in the United States and particularly in Japan, particularly for the accumulation phase, which is what we call the phase of your saving before retirement. Also after retirement, we'll see a particular case of that, but they're usually used as accumulation instruments, which are basically made of or thought of as means to ensure the minimum amount you want to retire with. So you'll have a minimum sort of quality of life when you retire. They look very appealing to the client, and it's very easy to communicate to a client how it works. You invest in this fund. If you die and the fund is worth less, I'll give you the difference. It's as easy as that. In its simplest case, that the death benefit, the guaranteed minimum death benefit. So they are relatively simple to communicate. However, they are terribly complex from within. They are terribly complex to value. They are terribly complex to manage in terms of risk. They are very, very complex in all fronts. This is why, as we were briefly discussing before, from a certain amount of time onwards, ever since, we've required the need of legions of financial engineers. People with normally very hard science backgrounds plus financial postgraduate education, as is the case of these workshops. Now, in my team, for instance, which is made up of 40 people, almost half of them are people with quantitative financial background, and the rest are actuaries, which is basically the same, but on the liability side. So it is a rather complex instrument from within, from the perspective of the company, not so much from the perspective of the client, in which there's normally a mutual fund, a normal mutual fund. Many times in the United States, for instance, the mutual fund is not even sold by the insurance company. You buy yourself a mutual fund wherever you want. You go to your usual financial advisor, for instance. You buy emerging markets equity fund, for instance, and then you would go to the insurance company and buy yourself the guarantees. So the value-added chain is sort of split up. And we insurers provide with the guarantees, and the banks and other financial intermediaries do the asset management. We are not so much into asset management. We are more into guaranteeing things. We are insurance companies. Although in our case, we are also part of a bank. So in our particular case, our guarantees are always associated to funds managed by CaixaBank. So that mutual fund account would have a series of guarantees, which are called the riders. This sounds very American, the riders. Each guarantee is a rider, and each guarantee can typically be associated to a financial option, a put option, most normally a put option in all its sorts and exotic ways, but they are normally all put options, not calls. Because the basic aim is to guarantee the minimum value of the fund, and you do that with put options. So they are basically OTC because they are sort of contracted between the client and myself. They are basically given out by the insurance company and bought by the client. So it's as if I'm selling puts to the client. But they are normally very, very exotic puts. They are not your type of European black and scholes put option on a single equity. They tend to be very, very complex to value. Hence the need for quantitative finance specialists in the business to actually value these things, to account for them, because in accounting, you've got to sort of input the value of it at each point in time. They can increase in value the guarantees to the company as well. They can make us lose a lot of money because we need to recognize the market value of the guarantee in-house, and that affects our financial statements and ultimately our solvency. In some cases, these products have been very, very dramatic. They have made some insurance companies go bust in the past because basically of mismanaging it. In the 80s and 90s, when this product became popular, insurance companies basically didn't know how to manage them. There were no financial specialists as well available to insurance companies. So there were many problems associated to this. When there were strong market swings, mainly downside strong market swings, or increasing volatility, implied volatility that seriously affects the price of options, then insurance companies, some of them even went out of business because of this business. So there's a sort of legend, of black legend associated to variable annuities in the world of insurance. This is the reason why now we began this line of business probably 3 years ago or so, and we needed to sort of overcome external scrutiny by our supervisors. The insurance supervisors, same as the banking supervisors, are very sort of averse of these type of products. They think that they carry many risks to the insurance company, because we undertake risk and we take risk off the customer and into the insurance company. We accumulate a lot of risk, a lot of financial market risk in the insurance company. And the supervisors think that this needs very, very careful risk management techniques, and they scrutinize us very heavily. They need to make sure that we are able to properly value the guarantee, to properly hedge the guarantee, and we'll discuss this later. On the other hand, variable annuities are the Ferraris, the BMWs or the Maseratis of the world of saving for retirement. They are very, very, very expensive. Particularly the living benefits, not so much the death benefits, because the death benefits are associated to mortality, and that makes them a lot cheaper. But living benefits, like guaranteeing a certain minimum amount for retirement, is very expensive. Annual management fees normally run around 2% to 3%, which is a lot. This in time places a lot of stress on the underlying assets, because obviously, I mean, every single year you're going to go and charge 3% on the value of the fund. So the fund, if you want to ultimately increase the value of the fund needs to yield more than 3% in order to appeal to the client like it is increasing in value. Otherwise, all the sort of value increases would be completely offset by my management fees. So you need ultimately high yielding underlying assets. Which is why the exposure to equity, as I said before, is normally very high. Many of them are 100% into equities, different types of equities, normally very diversified. And if they have fixed income, it's normally up to 10% or 20% at the most. So the underlying asset needs to be high yielding. Right. So the riders, the vocabulary or the taxonomy of the riders. A guaranteed minimum death benefit is a guaranteed amount upon death. So you've got this fund, and I can guarantee you that if you die within the next 5 years or the next 10 years, I will give you the highest of the market value of the fund or the minimum amount that we have specified. That can be a flat amount or an increasing amount or whatever. You've got to die. That's the condition. That's what makes the option cheaper. It is conditional upon death, which sometimes, I mean, it's at least an involuntary condition in most cases, of course. And that's the trick of it. It is very usual to use these products for inheritance planning. Imagine that you've got a certain age and that you've got some money set aside for your children. You want them to inherit it. You can save it under the pillow, of course, but you can put it into a fund with a GMDB that will give you the potential for upside. I mean, it can go up in value, so your siblings will inherit more, and it will be protected. If you die, they will inherit at least that minimum amount, that premium you've put in. And maybe more if there's a ratchet or a roll up as we'll see now. So it's very it fits very well the needs of inheritance planning for that particular time in your life in which you are setting aside assets for your siblings to inherit. It is working very well in Spain. We launched GMDB for the first time 4 years ago, and we've sold in excess of 2 billion worth of it, 2 billion euros, making it one of the most successful products we've ever sold. We began with a 5-year guarantee, and then we sort of upgraded it to a 10-year guarantee. I'll tell you about the problems of the time span of the guarantee later, if you wish, because that was a sort of difficult upgrade. to engineer. But now our clients are enjoying that 10-year guarantee over three very specific funds that the bank manages, and we guarantee. There's the GMAB, the GMAB, as they say, where the A stands for accumulation, and this is this is a living benefit, and this is a much more expensive animal, as you can imagine, than the GMDB. This one, what it does, it basically guarantees that you will have a certain amount of time as a minimum at a certain point in the future, normally at retirement. Or maybe if you want to, for instance, save for your children going to university. You want to send them to very expensive universities like, I don't know, Harvard. You begin to save now, and you need a product that ensures you that you will have at least enough in a certain point in time in order to cover Harvard's fees. And if there's any upside, then all the better. But at least I need to have that certain amount of money at a certain point in the future. That's where a GMAB comes in. As you can see, it's this one is simpler. In its simplest form, a GMAB is not subject to, it's not conditional upon mortality. It's a simple European put option. So it's not that exotic. The exoticity comes in the fact that it's normally not on a single stock. It's on a mutual fund, and normally a set of mutual funds where the client can switch from one another, and that is where the exoticity comes in. But outright, it's a plain vanilla put option that I'm selling to my client. I'm giving away to my client. Then there's the guaranteed minimum income benefit, very popular in the United States. We are not planning to launch a GMAB anytime soon. We are more into studying how a GMAB would work in Spain. That's our plan for the future. And I'm giving out some strategic secrets now, but no, it's no secrets really. We tend to be very outright spoken about it. But a GMAB is very similar to a GMAB, only instead of a single payment amount, what it guarantees is the purchase of an annuity. You buy yourself a pension upon retirement, and it guarantees a minimum pension amount. It works the same, with the only difference that it comes with the conversion. It comes in with the purchase of that annuity that people do normally upon retirement. The way accumulation and decumulation works for most people is they normally invest in products with some degree of risk during their accumulation phase, during their working phase, and when they retire, they buy themselves an annuity that is a single payment each month. You buy it outright, and it's normally a lifetime annuity that would sort of fund your excess returns over the Social Security or any sort of government income scheme for retired people. You would have that additional money to spend in, and normally for a lifetime, normally for up until death. So that's an annuity. And with a GMAB, what you obtain is the guarantee to buy a minimum income in the form of an annuity. And then the GMWB is also an interesting one. It's a guaranteed minimum withdrawal benefit. This is for retirement. This is the only one that's meant for after retirement. And what it guarantees is that you will still have the fund, and you begin to take money out in the form of a pension. Again, a sort of annuity. And what the insurance company guarantees is that the fund will never be depleted. You can, for instance, buy yourself a GMWB for 5 years, withdrawing 20% of the fund every year. The fund will change in value, but you will always take 20%. And if at the end of the 5 years there's money left, it is yours. If at the end of the day the account has gone negative because the value of the fund has gone down in value, but you have kept withdrawing your guaranteed amounts, then the insurance company covers the difference. You'll graphically see this in a second. Now, going back to the GMDB, this is the simplest GMDB with a 6-year return of premium. You can see there, basically, this is the easy one that we told about. You put the money into a fund, the fund will go up, go down. If you die at any point in time during the next 6 years, you get the maximum of the fund value or your initial premium, or the red line that you see there. So if you happen to die in year 2 or year 3, you would get the red line. If you happen to die in year 5, you would get the gray line. It works as simple as that. Okay, so if you look at it like an option from the perspective of a quantitative finance practitioner, you would go and say, well, okay, how do I value this? It looks like an American put option because it can be exercised anytime, doesn't it? The only tricky thing is that it cannot be exercised at will. Exercise of the option is subject to death, is subject to mortality. So the exercise time is random. And this is particularly the key or the defining exotic feature of a GMDB as an option. Now, the underlying asset is usually a basket of portfolios. So you would normally have 3 portfolios. For instance, one would invest 50% in equities, the other 60, the other 70. So there's, as you know, all the exoticities associated to the fact that it is a portfolio, not a single instrument, what we are valuing the option on. So it's there are correlations involved, etc. And then there's also a sort of dynamic behavior allowance on the side of the clients, because they can switch from one fund to another in the 3 funds between the basket at will, as they wish. So they can go from the more conservative one to the most aggressive one at any point in time. This is what differentiates a GMDB from a vanilla put. These key features, these 3 exoticities. Now, in the old days, now this is very difficult to achieve because of low interest rates, etc. But in the old days, there were GMDBs with roll-ups, so that the minimum amount would automatically increase on a continuous basis, as is shown here, or stepping up the value every year. So you would have the same exoticities as we saw before, but with the additional exotic feature that the put strike price, the strike price of the put option, is not static. It accrues, it varies, it increases at a rate X. You can have, instead of continuous put increases, you could have ratchets. A ratchet is an interesting thing. It's like a look back thing, and it sort of consolidates the guarantee. So if you have an annual ratchet, for instance, a 6-year GMDB with an annual ratchet, then every single time the fund value is over and above the level of the guarantee of the initial premium you paid in, then the guarantee sort of consolidates. If you see the example, well, you buy the GMDB first of all, so the guarantee level is the same as the fund value level at the origination of the product. Then the fund value goes down, then nothing happens. But if the fund value goes up, and then there's a ratchet day, there's an anniversary day, then if the fund value is above the guarantee, the fund value would consolidate and increase the guarantee. So that's better. It is a more protective policy, it is better for the policyholder, obviously, and hence it is much more expensive as well. So the exoticity here is that the strike price is subject to a sort of maximum off feature every year. This is a GMAB, a guaranteed minimum accumulation benefit with a 6-year return of premium. This is the simplest type of GMABs. This is the one that we are planning to probably begin to design. We're at that sort of early phase at the moment. And it is as simple as this. I mean, at the end of the day, at the end of 6 years, I would have this amount of money. It is invested in the stock market. It can go up and down. if I withdraw all my money before year 6, I get the fund value. The put option is European. It is not American. I cannot exercise it at any point in time. If I exercise it before retirement, I get the fund value only. But upon retirement, I have a minimum amount. In this case, as you can see, the gray line is slightly above the red line. So the maximum would be the gray. But if the stock market had plummeted the year before my retirement, for instance, then I wouldn't be affected by it. I would get at least the red line. So that's the risk that I would get covered with a GMAB. I'd sort of mitigate the risk as an investor, as a saver, of the stock market plummeting on the day of my retirement or on the day before my retirement. That's the key risk. Okay. Please stop me with any questions as I go by. Now, interesting combinations. GMAB with a 6-year return on premium plus a ratchet. Now, same as the GMDB, the GMAB can consolidate sometimes if there's such a clause in the option. If on any anniversary date the fund value is above the guarantee, then your guarantee would go up, and it would never go down. But it would go up if it would sort of consolidate capital gains in the account if the market goes up. This is better for the policyholder, and hence the cost is even higher. Okay. And then the GMAB might roll up. Remember that in a GMAB, normally surrendering the policy, i.e. withdrawing your money within the time span of the GMDB is not possible. I mean, it is possible, but it is possible at fund value. You are not protected in between. You are only protected in year 6. Remember, it's a European put, not an American put. But still, the value can accrue some interest. This is classic in the old days. There were roll-ups. Now it doesn't. Now it really doesn't. The classic GMAB that is being sold now is this one, the plain one with just a flat return of premium. Okay. Now income, GMIB. Consider a GMIB with a 6-year conversion. So you guarantee yourself, same as a GMAB, that you're going to have a certain amount of money in 6 years at a minimum, but and that certain amount of money is going to be invested in an annuity that will give you, I don't know, 500 euros every month. This is basically the same as a GMAB, only associated to the fact that you've got to purchase an annuity from the same provider every year. This is done for commercial reasons. You obviously retain the client not only before retirement but after retirement as well for the decumulation phase. So in that case, imagine as compared to a GMAB where we sold that the fund value was actually slightly above the minimum guaranteed amount. But in the case of a GMIB, I would normally need more money to buy myself a lifetime income annuity, and then if that money is short in the fund account value, then the insurance company would actually top it up, as in that green arrow, so that you've got enough money to buy yourself the annuity that you want, that was guaranteed. Okay, the annuitization, which is how it's technically called. So that's another one of our long words for today, annuitization. Right, GMWB at 20%. 20% means the amount of money that you withdraw each year from the fund in dollars. So it's calculated as 20% of the initial amount. So it would work like this. I would sort of completely deplete the value of the fund. If the fund hasn't changed in value, as in this slide that you're seeing there, then nothing would happen. I would end up in year 5, and the fund account value would be 0, and then everyone's happy. You know, I've obtained the amount of money that I wanted to withdraw, and the insurance company option has not been exercised. But if the fund value goes up, then I would have a remainder. I would have a residual amount of money left in the fund account value, and after year 5, I could cash it in. It's mine. Okay, that's so I get the upside. And if the fund value goes down, then and I go and withdraw my annual withdrawal amounts, and I enter into negative territory, for instance, in year 4, if that happens, the insurance company would step in and top up the fund account value up to 0. So it would replenish the fund account value. This is the option being exercised. The option would be triggered, the option would be exercised, the put option, whenever the fund account value falls below 0, which is fantastic for the perspective of the client. I obtain all the upside of the stock market, and if the stock market and the downside is absolutely limited. So I am ensured, I am assured by my insurance company that I will at least obtain that red amount of money every single year during the next 5 years. Okay, it's different from an annuity though, because this is only typically for 5 years or 10 years. It is impossible to guarantee any more than that. I mean, there are some lifetime GMWBs, but those are terribly expensive, and they are also limited in volatility by other means, which we are not going to enter into today. So it is a sort of post-retirement product, but usually only for the very few years immediately after your requirement. Otherwise, the option becomes just too expensive. Right. So what's more popular? This is a very old survey, but we wanted to take an old survey 3 years ago. We wanted to launch this in Spain because we wanted to know how the market was in the United States when these products were new at the time. Because this was 3 years ago a completely new product in Spain. So we were the first ones to go ahead and launch it. So in 2008, the most popular living benefit within Americans was the GMIB. The GMIB. Remember the guaranteeing of a minimum pension account, and the classic death benefit was a death benefit with a 5 to 7 year step up. Those were the days. Now the most popular death benefit rider is the return of premium, which is second or third in this chart that was back in the 20s, so a million years ago, or so it would seem. We are now in a very, very different economic environment, particularly as far as interest rates are concerned. Right. This is just an example that these animals are very, very expensive. The GMDB that we are selling is around, well, it depends on the underlying fund, but the average, the fund in the middle is about 1.50% in terms of annual management fees. If you add in additional riders on top of the GMDB, it can go as high as 3 or 4%. As I said before, this is tremendously expensive for the world of asset management. It places a lot of strain on the underlying fund to perform, because otherwise these annual fees will sort of erode the accumulation of capital of the underlying fund over time. That can be a risk in itself. So that's usually something to deal with carefully. That effect of very, very high management fees on the possibility on the upside of the fund, which at the end of the day is what is all about, finding a way for a client to benefit from the upside with limited downside. If the cost of limiting the downside is such that you wouldn't have any upside either, then the product wouldn't simply make sense. Okay. Okay, so for those of you who might be interested by this, and from the perspective of a specialist or a professional in quantitative finance, what are the quantitative finance implications of this? How do we go about valuing things like this, in particular GMDBs, which is something that we built the GMDB valuation model 4 years ago. We had it approved by a supervisor 3 years ago, and we began to sell immediately, just straight after supervisory approval. And the model has been running ever since very successfully. We've been using it for valuation, and then the value of the guarantee is important, obviously, for accounting purposes, and then for risk management. And I'll tell you a bit about that later. Right. So the thing with the GMDB, as we said before, the exoticity of the GMDB is basically the mortality factor, which makes the time to exercise of the option to be random, to be stochastic. So what we did was to build ourselves a plain economic scenario generator, which is what we chose in terms of valuation methodology, a Monte Carlo type of approach, and then we would simulate the policies along the 5 years of the policy and of the guarantee, and then some of them would simply die along the way using the probabilities of death that we have from our other models that we use for our other life insurance products. Bear in mind that this is a savings product for which we don't normally require a declaration of health from the policyholder, nor a medical examination, which we normally do for protection products. So there was the risk of adverse selection. This is a perfect product for terminally ill people, for instance. If you are terminal, this is the perfect product for you. And we cannot sort of filter that because there's no filter. There's no declaration of health. There's no medical examination whatsoever. But for people with very limited life expectancy, this is perfect because they will know that they can benefit from this sort of upside without downside for their investment horizon if death is in between themselves and their investment horizons. And obviously there's no assets out there that we can go and buy and hedge the mortality. So we need to sort of engineer the mortality hedge ourselves using our own internal model for mortality and our own mortality rates. It's not that difficult at the end of the day. It's basically multiplying the Greeks times a mortality rate. Okay, GMDBs are usually long-term options. This is the implicit volatility problem. If you want to value an option, you need to, as you know, there's a thing called the implied volatility factor that you will need to go outside, look at the market, see how options on those underlying assets are trading. That's your implied volatility, and then you use it as an input into your own valuation model. But obtaining implied volatilities from the market is very, very difficult. You go out there, and there's only quoted options in option exchanges for the next couple of quarters, and not on all assets. So this is what made us limit the range of acceptable assets, so to speak, admissible assets of the underlying basket of funds to only those where we could actually observe the implied volatility in the market, because we need that volatility in order to value the guarantee that we are giving the client. So you can find options traded on those instruments which belong to your portfolios, but then again, the maximum length of those options will be 1 or 2 quarters, 6 months at the most. And we were planning to issue a 5-year guarantee. So we needed to extrapolate the volatility surface, as it is called, this is an example of a volatility surface. I'm sure you are familiar with the concept. It's basically a 3-dimensional relationship between strikes, implied volatilities, and maturities. So we needed a 5-year volatility surface, and after some time, a 10-year volatility surface, because we wanted to extend the guarantee term to 10 years. And that was basically something that we couldn't find in the market. We extrapolated to 5 years first, and then we extrapolated to 10 years afterwards. I've got to confess to you that extrapolating a surface to 10 years from an observation range of only the first 2 or 3 quarters is like jumping in the dark. That's something we always felt very, very uncomfortable with. The only thing that sort of more or less let us be more confident on that sort of massive long-term extrapolation was the fact that when we saw the animal begin to behave, the extrapolation works as a smoothing technique. So basically, the volatility occurs mostly in the observable rates, and the extrapolating tranches are just extrapolated. So we felt that was very, very good in terms of balance sheet volatility. So the price of a longer term option is actually more stable than the price of a short-term option, because implied volatilities and the volatility surfaces are extrapolated to such a term that prices tend to be more stable. Prices of the option. I mean, that was a very interesting debate, particularly with vis-a-vis the supervisor. Now, this is a graphical example of what we did. We built ourselves a Monte Carlo model with 10,000 scenarios, with full revaluation of each one of the 3 underlying portfolios in each, and then we applied the payoff function, as you would do if you want to Monte Carlo value every option you could imagine, particularly if it is as is the case an exotic option. We were tempted to look for an analytical solution, and this is probably an interesting challenge that I can dish out to you today. An analytical solution would be great. We wouldn't need to run the 10,000 scenarios, which basically take place overnight. We left the machine running. We came the following morning, and we've got the option value. An analytical solution, as in black skulls, would be great. However, we made some research into academic literature at the time being. There were some pieces of literature on analytical approaches to the valuation of GMDBs, but the assumptions were so cumbersome that we were not totally confident of analytical methods. However, they would be great because computing power is costly, is slow, etc. But it would be great. So this is for valuation. What about risk management? And this is the last bit of it that I want to tell you about today. Risk management is a crucial element when selling this product. You cannot just go and sell it. You are selling put options, and you're giving away basically instruments in which you will always be on the worst end of the equation. The client is expected to win always. I mean, if the stock market goes up, it is not a sort of shared profit participation. They get all the benefit. If the stock market goes down, then I get all the losses. It is asymmetric, strongly asymmetric. So I need to cover those. I need to cover those liabilities, those potential liabilities. I need to hedge those variable annuities. So how do you hedge one of these animals? Again, with a lot of quantitative finance, of quantitative techniques. In the old days, variable annuities went unhedged, first of all. Insurance companies thought that markets were not going to be very volatile, and several of them went broke as a result of that, because of the variable annuity business. And that's why, as I said at the beginning, this is the reason why still today, the VA business is still regarded as a high-risk business for an insurance company, one that you need to deal with the most state-of-the-art quantitative techniques and with the best amount of talent in terms of quantitative talent. Then things were things began to get sophisticated slowly. First of all, with simple strategies such as calling your investment bank and buying some put options or some static solutions that were very popular in the 80s, for instance, in the 80s and early 90s, and they were offered by investment banks. The reinsurers came in the 90s and early 2000s, offering the possibility of reinsuring these things, which is transferring totally your risk to someone else. We partially use reinsurance for this, and it also made the landscape of reinsurers change, because reinsurers either entered into strategic alliances with investment banks or asset managers, or they needed to change themselves and begin to hire quantitative specialists as well. So there you go, another point of entry of quantitative finance specialists into the financial industry via reinsurance. It was only in the mid-year 2000s that there began to exist some decent risk management programs in the market. We've got one called Numerics, which we bought in New York. We had to go to New York to buy this, because in Europe, this is such a small market that there are really no sophisticated risk management programs. We went out to New York. We found a software firm in New York specialized in variable annuities, and we bought their software. And we use their software for valuation and for hedging of our variable annuities. And then today we are more into thinking that we've got the right software, but what many insurers have missing is the actual governance around it. In the fact that many times variable annuities, when they are still designed and sold, the risk management department is not usually taken into the discussion at a very early stage, which is what should happen, because risk management is such an important part of this product that risk management decisions will be fundamental. In our case, I have to say that this was something that we entered into very, very early in the discussion. The risk division that I lead was instrumental in the design decision from the very beginning. But obviously, this has been very recent, and we do this because you know that these products have given a lot of trouble in the past if you don't do it this way. So that was the sort of lessons learned from the industry. Right. So if you think about it graphically, what's your risk? First of all, you've got a mutual fund as a unit-linked fund, as it would be for any other unit-linked fund in an insurance company. So in a unit-linked fund, the assets and the liabilities move in unison, and you don't take any risk. So it's a pure mutual fund. If the market goes up, the liability goes up. If the market goes down, the liability goes down. So does your balance sheet in full. So there's no risk. But then there's the guarantees, which are a liability to you. They sit on the liability side of the balance sheet. How do you cover it? Well, you need something to invest in that basically mirrors the financial behavior of the liability on the asset side. If the value of the guarantee goes higher, then the value of the asset needs to go higher. What sort of asset? Well, many times we think that we can sort of take this problem onto someone else, as is the case of reinsurer. But you can also do is to cover it yourself. Buying options, it can come as no surprise that we cover options that we sell on the liability side, buying options on the asset side. And because most of the options that we sell on the liability side in this business are put options, the options that I need to buy on the asset side are also put options normally. For this, I'll go back to this in a minute. But for this, we need to be clear on the Greeks, which is something that I'm very sure that you are familiar with. How do we use the Greeks at insurance companies in order to hedge the liabilities that we sell, the liabilities with embedded options that we sell on the asset side? Well, you know all of them. The ones that we are normally most concerned about are the delta and the vega. The delta is basically how short you are in the underlying asset. So we basically normally hedge this with futures or buying straight put options. The Vega is very important as well. I mean, there was a trend in the 90s and early 2000s of not hedging the Vega. And that was very, very troublesome for many companies, because if there's a sudden surge in implied volatility, then you can run into trouble. The value of the liability can increase non-exponentially. And it is very difficult to explain internally to your board of directors or your management committee that there's something strange called the Vega, or the implied volatility, that has impacted your profit and loss account by 20 million. This is something that we consider basic, we consider fundamental to hedge against, and we hedge the Vega. The rest are normally ignored. The theta to ourselves is not a risk factor. The gamma is really offset by doing very frequent rebalancing, and we do it daily. Normally, we're still in simulation mode only. We're not doing real hedges, but the gamma sort of diversifies away if you do very frequent seeing delta rebalances, because as you know, the gamma is a sort of second order exposure on the delta. And the rho, our options are not very sensitive to interest rates. They are much more sensitive to the underlying values of because they are mostly equity. So we normally ignore those. In fact, there's a few examples down here in the presentation on pages 32 and 33 of, we try to figure out how often would we do the hedging, and we compared the effectiveness of daily hedging on page 32 and weekly hedging on page 33, and we came to the conclusion that weekly hedging was beyond risk appetite. We had no tolerance for it, and we settled down for daily hedging. That's one of the first decisions we made. We also made the decision to execute a delta Vega hedge that you see down there in orange. That's the one that we are choosing. The blue one, which is only a delta hedge, sounded quite volatile to us in terms of mismatches of your hedged assets and your liabilities. You've got the numbers there, if that interests you at all. So in our particular case, we decided to settle down for a delta Vega daily hedging, but that's a key decision that you need to make, and it will vary according to your risk tolerances. Ultimately, how much risk do you want to ultimately retain or diversify away? Now, I wanted to show you this because there's an in between, and this is basically my last remark probably. There's an in between fully reinsuring the liabilities. You don't need to worry about them. You just have to value those, and you just have to worry about the counterparty risk of your reinsurer, your credit risk vis-a-vis the reinsurer. And you can also enter into the buying of options in order to fully hedge it. But there's somewhere in between. You can do a sort of partial reinsurance and in turn a partial hedge, which is what we ultimately went for. For instance, we calculated that the numbers of scenarios with accumulated losses exceeding 40% was very low, was a number of scenarios that we could easily tolerate in all three of the underlying funds with their different underlying volatility. So we said, okay, reinsurer, how much would you charge me if I absorb all losses in excess of 40%? And that made the reinsurance option very cheap. And that, in fact, increased the margin for us. We are undertaking a tail risk, which is not the type of risk that we normally want to take. It is an extreme risk that we are absorbing. Normally, reinsurance would work the other way around. I would sort of reinsure my tail risks and retain my sort of body of the distribution type of risk. This time, it works the other way around. Most of the claims are actually covered by the reinsurer on a daily basis, but if there's a strong stock market collapse, then I would sort of retain the residual tail risk. We did this because it is cheaper. It made it cheaper. And okay, that is something that we talked about, the mismatches using various hedging strategies. And yes, a final thought, and I promise it's the final. Value at risk. For risk management purposes, you want to limit the losses that you might incur in. And for building a value at risk, whenever you're talking about variable annuities, you need to go for nested models. And I'm sure that many of you might have heard this concept. By nesting, it means that first of all, I need to simulate, as in any value at risk model, some real world scenarios in which, and my value at risk would be the 1990th percentile, for instance. And then for that 1990th percentile, I would need to value the option. And I would need to simulate market consistent or risk neutral scenarios for that specific stress scenario and then value the option. And that would be the stressed value of the option. So the model is slightly more complex because in some ways I need to have two scenario generators in one. And this is something that we covered with that software I told you about, with numerics. And that's it. Many thanks. Are there any questions, comments, complaints, anything?
Thank you, Ismael. I see a question in the chat. I can read for you if you don't see it. Is this Anna? Thanks for the insightful presentation. Could you highlight the difference between GMDB reserve valuation under local GAAP versus Solvency II? I understand that under Solvency II, valuation allows for stochastic modeling, but how is it valued under local accounting?
And as a market on a market value basis as well in this particular case, but the assumptions are slightly different because you cannot take lapses into account in accounting. Under local GAAP, you cannot take lapses into account, whereas under Solvency II you can and should. And if you want to use a mortality table under Solvency II, you can use an internal model if you want, which is our case, if you are approved to do so by the supervisor. But under accounting, you cannot use an internal mortality table. You've got to use one of those industry-approved mortality tables like the per 2020 or whatever. Those are the difference. But the philosophy is the same. The valuation basis needs to be at fair value, market value, and changes go through profit and loss. So they impact the P&L.
Thank you. Are there other comments or questions? Elisa, you have okay.
I have a naive question. Ismael, can you tell us a bit about your view of classical modeling and these new machine learning techniques in the financial industry?
Oh, that's a long shot. We are we are beginning to delve into machine learning, not for this, but for other parts of the insurance business. If you think of insurance, the business of taking risks is very varied, and machine learning has a lot of potential for us. For instance, in life insurance, there's a lot to learn on why people die. We've traditionally taken two factors in order to value a liability, which were age and gender. And gender we cannot use for pricing anymore because it is forbidden to discriminate price in terms of gender. So we can only use age plus some adjustments for smokers versus no smokers, but that is normally done on the basis of bad data. So at the end of the day, it's only age. And but mortality and longevity are very, very complex phenomena. There's many discussions around the future of longevity. We've got a very, very large pension business out there. We are the second payers of pensions in Spain after the Social Security. So we need to learn a lot on the actual future behavior of mortality. and machine learning could be a solution in this. So we're beginning to delve into it, and that's just an example. So I see a lot of potential. I think we are only beginning to see the potential of it rather than beginning to use it, actually. So still, I would say that today, as we stand today, we still rely on 100% basis on classical modeling of assets and liabilities.
Okay, thank you very much.
I see some congratulations from the conference, Ismael. There are people saying great presentation. It was fantastico.
Thank you.
So
It's
I
been a
think
pleasure.
that we all appreciated your presentation.
It's really been a pleasure. It is really fantastic. I thought it was, well, this is basically Elisa's idea. And I thought it was a great idea to have a bit of a different approach in one single slot, a bit of a practical approach on how things are done out there in real businesses. So I really hope you found it interesting.
Super interesting.
Sure, I think that all the three conferences this morning were pretty much strong and concrete. So I really thanks all the speakers, and see you tomorrow morning at 9. So congratulations and thanks to all the speakers.
Thank you. My pleasure.
I don't know if Elisa and Joseph has some announcement or...
I think it is nothing special. I don't know, Giuseppe, tomorrow we meet us again at 9.
Yes, yes.
And we follow.
Okay, we continue tomorrow. See you tomorrow.
Okay. See you. Bye.
Bye.
Bye. It was very nice, I think, Joseph.
Yes, yes, yes. Very interesting talks today. Yeah.
Yeah. I will have some problem tomorrow morning for some committee, so I will come in and out, whether this is not
tomorrow. Yeah, tomorrow the chair is Elisa.
okay.
So,